All right, welcome back. So we're going to keep talking more about inflation. So last time we talked about treasury bonds and how they can protect against inflation. Today we're going to do a quick comparison here of stocks versus real estate, in which we think is better as far as an inflation hedge. So the first thing that the topic to talk about is leverage, right? So you're typically buying stocks with cash, typically, and you're buying investment real estate with leverage, meaning OPM, using the bank's money or some other lender's money. Now, the loan is typically, you can get it at a fixed rate. So right now, people are concerned about rising interest rates. However, if the real rate of inflation is say 10%, and some stats say it's actually closer to 15% on the consumer side, then you're able to have a constant payment to the bank, right? You're paying 5% interest to the bank, a fixed amount over a period of time, but inflation is rising. So naturally, the dollar becomes less powerful over time. You're paying the same amount though, right? Your payment's not inflating. Your fixed mortgage doesn't go up because of inflation. So the gap widens. So you're naturally sort of hedging against inflation with a mortgage by using debt. So if someone's looking at debt versus cash for real estate, debt's the way to go there. So that's a powerful hedge on itself. Second, depreciation, right? So what is depreciation? It's cost recovery. It's something that the government gives real estate investors to write off the value of their asset over time. Here's the trick. If you buy, say, a $500,000 house, investment property, and you only put, say, $80,000 down, you don't depreciate the $80,000 that you put down. You depreciate the full value, right? So the less you put down, the better in this case. So the government gives you an ability to write off the value of that asset over a period of time. Now, there's several tricks to the trade here in kind of advanced tax planning that you can write off more in a given year that's beneficial to you. Now, with stocks, you don't have the ability to depreciate the stock, right? It appreciates over time, but you don't write off that investment basis in it. So that's kind of a key difference there. And depreciation is what's called a paper expense, meaning it's not actually money leaving your pocket. It is just a paper deduction only, which is very, very powerful. So depreciation is massive for real estate investors. Third thing is your cash flow, right? So stocks, they may or may not provide dividends, right? Some stocks give dividends, some don't. That would be the equivalent of cash flow to the stock, right? Do they pay you a dividend every year or do they not? Now with real estate, you're almost always getting cash flow from the real estate. If it's a good investment, it's going to return you cash flow from your tenants. Now with the amount of deductions, right? Using leverage, you're juicing your returns because now you're getting a deduction for the interest you're paying to the bank, plus this depreciation, plus the whole slew of other business deductions that are available to real estate investors that are simply not legal and allowed for stock investors. The real estate gives you these extra deductions, which means at the end of the day, the majority of real estate investors will pay zero taxes on their cash flow. And in fact, if they're advanced in their planning, they may be able to create what's called losses, tax losses on their real estate and write that off against other income they have, right? So it's a double play there. And the last thing is appreciation. So we think that both classes here, may appreciate. Stocks tend to be a little bit more volatile in the current economy, right? They could go very far down and very far up, especially tech stocks. Those equities tend to sway a lot. But over a period of time, say 20 years, they're both going to appreciate. That's what history shows us. Right now, why real estate, again, is a good inflation hedge is the stats show that there's about 400,000 homes for sale at any given time in the United States. And the current trends show that we need about 900 to 1 million houses available to the general public. So there's a huge gap, right? Supply and demand. So one may believe that with that amount of demand and a lack of supply, depreciation will keep going up. The pool of buyers will go down with the interest rates going up. So again, an interesting play there as well. And that's kind of an economic discussion that some may get into. So overall, inflation is going up, but investment real estate still may be better than other alternatives, even with the interest rates changing. So I encourage you to look more into this and reach out if you have any questions.